Welcome back to the deep dive. When we think about government employee pay, we usually just picture a routine, modest annual bump.
Right, the typical 3%.
Exactly. But about once a decade, everything changes. Today, we're diving into the Eighth Pay Commission, which is not just an increment, it's a full-scale structural reset of basic pay, allowances, everything.
Pensions, too.
And pensions, yes. The core idea is pretty clear, right? You have to bridge that widening gap between, a static income and rising living costs.
It's about protecting purchasing power.
Absolutely.
But what's really fascinating here is that this is so much more than just payroll management. For you, the listener, this is basically designed to be the single largest growth trigger for India's consumption story.
A growth trigger.
A massive one.
Yeah.
If you're tracking the auto industry, real estate services, this income injection is the policy lever you need to watch. And we know it's coming. The terms of reference were notified on November 3, 2025.
And the scale is just, well, it's truly staggering.
Right.
We're talking about nearly 18 million employees.
That's central, state, local bodies. The works.
Plus another 13 million pensioners. So all in, you're looking at roughly 30 million people on the government payroll.
Yeah. And just for context, what's the largest private employer? TCS, they have, what, 0.6 million?
Not even a million, so the footprint is just enormous. And that 18 million, that also includes the CPSEs, the central public sector enterprises, right? The government-owned companies.
Exactly. It covers that entire public sector universe. Now, to gauge the actual impact on those 30 million people, you have to understand the Fitment factor.
A Fitment factor. Okay, what's that?
It's basically the key multiplier. It's the number your current basic pay is multiplied by to calculate your new starting salary.
I see. So it's the core of the whole calculation.
It is. The Seventh Pay Commission, for instance, used a factor of 2.57. For this eighth one, the projected range is, well, it's pretty wide right now, somewhere between 1.8 and 2.86.
Wow. Okay, that's a huge range, 1.8 to 2.86. What drives that volatility? Is the government just trying to manage expectations?
It's a bit of both. I mean, the final number is always a political and an economic calculation. But we know from history that these payouts can cause serious fiscal shockwaves.
You mean like the Sixth Pay Commission back in 2008?
Precisely. The central wage bill jumped from 2% of GDP to 2.8% in just 1 year. That's a sharp jump of 80 basis points.
But that sudden shock wasn't random, was it? As I recall, that massive jump happened because the implementation got delayed.
You're right. 2 full years of arrears hit the budget all at once. It was a massive lump sum payout.
A huge payout. And if we connect that spending power to the larger economy, the consumption boost must be undeniable.
Oh, it is. The Seventh Pay Commission was so influential that private consumption grew by 8.1% year-on-year in FY17. The central bank even estimated that without that revision, real GDP growth would have been lower by about 200 basis points.
Wait, 200 basis points? You're telling me 2 full percentage points of GDP growth came from this one policy lever? That's almost hard to believe.
That's the power of a synchronized demand stimulus. And it's not just consumption, it's investing, too.
So it boosts savings as well.
It does. Historically, these commissions boost household savings.
Yeah.
After the 7th CPC, we saw financial savings really strengthen with a visible shift toward equities.
Interesting. So employees are not just spending the raise, they're thinking about long-term wealth.
Absolutely. We're expecting something like 2.4 to 3.2 trillion rupees of additional income to land at employee accounts. From that, we expect incremental savings of around 1 to 1.5 trillion to flow into assets, deposits, and the markets.
Okay, now for the painful part, the cost. UBS estimates the Eighth Pay Commission will cost an additional 4.5 trillion rupees. That's about 1.1% of GDP. That's a massive hole to fill.
It is. The resources will have to come from somewhere. Higher tax revenues, maybe.
Or cuts in other government spending.
Cuts in spending, or potentially allowing a fiscal deficit to widen just a little. But here is the critical problem, the biggest hurdle, really, which is the states. They could end up shouldering nearly 60% of the total impact. And state budgets, they operate with much tighter fiscal constraints and way less borrowing flexibility compared to the center.
So it's a much bigger problem for them.
A much, much tougher decision.
So to wrap this all up for you, the Eighth Pay Commission is a huge structural reset. It's aimed at protecting purchasing power and, more importantly, supporting consumption-led growth across the entire economy.
Right. And that brings us to the final thought. Given this massive and, frankly, necessary demand stimulus, the critical question is this. How exactly will the states manage that disproportionate 60% fiscal burden without compromising other essential priorities like infrastructure, healthcare, and education? That's where the real stress is going to land.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.